Hey everyone, Craig Gordon, Vice President at Prevail, and I'm joined by Andrew Stafford, our President.
Good to be here.
Good to have you. I think there's a lot of discussion out there between traditional money management, which I would say is more of a buy and hold type strategy, doing that for a lot of years. Most firms kind of go in that type of a model versus actively money management. And sometimes that may get confused with day trading and a variety of other things. So
explain a little bit what you mean by active management.
That's right.
Okay.
Explain by active management and why we believe that's the best approach in today's environment.
Well, I think let's start with active management. I think for us, active management means that we are using individual equities. We're setting an entry and an exit point. We're going in and out, and we're following market cycles. We're very nimble versus a traditional approach that says, I've got a 60-40 portfolio, which would be a balanced portfolio.
Right.
And inside of that, there has to be X amount dedicated to large cap, X amount to mid. I need some international, and I need some fixed income exposure or bonds, right?
Classic.
And that's a very classic. I want to get to the fundamental reason that a lot of firms don't do that is scalability. If you're running just a very traditional organization, it's very scalable to have managed models. Now, they will say they're actively traded, and what they're in essence doing is rebalancing the mutual funds or ETFs to match a 60-40 blend. Or if it's going to be aggressive, it's 80-20 or 90-10, or conservative 60-40 with the flip, right? 60 being fixed income.
And when
40.
you say you're rebalancing for the audience here, that's when a certain amount that maybe was only worth 30 or 40% has now gone up to in value to 50%. Hey, we got to rebalance.
Large cap grew too much, and so it gets rebalanced. Then they'll call that active management. Now, and so the active trading. Now, one of the things that you'll get kickback a lot is, well, it's maybe not as tax efficient, right?
Sure.
And so there's two ways to look at that. If you look at it in a silo, that may be true. They're definitely not as tax efficient as a buy and hold strategy. But do you know how many clients that we have taken assets away from another advisor that they've held for so long, and they no longer want to hold that asset?
They're held prisoner.
They're held prisoner, and the asset is declining, but they're afraid to sell it because of the gain that's in it, and it's just become so large.
They're letting the tail wag the dog.
They're letting the tail wag the dog. And so in our world, where we have other asset classes and other strategy like private real estate and things that can offset some of the passive or the investment income that's generated by actively trading, we pull the overall tax burden down, or we can, depending on each specific client, to where it becomes much, much less impactful. But the way that we look at active management is 40 of the 50 largest intraday swings inside the S&P 500 have happened in the last 10 years.
Unbelievable.
You either have a choice. You can either be a victim to volatility, or you can use volatility as an asset class, which means I'm going to pull risk off the table as we see volatility coming. And then when we see bottoms and we think that we're going to get bullish, we can put risk back on. That's active trading, right? That's not just, hey, the 60-40 balanced portfolio is this. And when one part of the asset class, large cap, small cap, gets out of balance, we rebalance it back down.
Agreed. And we think volatility is here to stay.
It is.
So,
absolutely.
If you'd like to learn more, check us out, prevailiws.com.